Hey everyone, in this video, I'm going to bring you my top 10 dividend stocks to buy for passive income investors in 2024. Now, interestingly, 2024 could be a good year for dividend stock investors. The reason? Well, I think the Federal Reserve is likely going to decrease interest rates several times in 2024, and that's going to decrease the government bond yield. So for those investors that are looking at generating passive income, the government bond has been very attractive. During some parts of this year, you could have bought a government bond, which is essentially a zero risk asset. You could have gotten a yield up to 5.5%, 5.5% for long dated 10, 20, 30-year government bonds. So you could have secured a yield of 5.5% on a zero risk asset. So if you're a passive income investor, you're looking at that and saying, well, why would I even consider dividend stocks if I can just buy that government bond? In fact, a few weeks ago, I went to see my chiropractor, and that's precisely what he was telling me. Why would I take any risk, he tells me, when I can get zero risk assets? He was talking about government bonds, money market securities, and certificates of deposits that were all yielding over 5%. So he said he locked in over 5% yields for the next 20 years. Didn't even want to consider dividend stocks. And that's understandable. So now in 2024, with interest rates coming down potentially, right? It's not for sure. That could make dividend stocks more attractive as passive income investors when they look out to try and generate that yield. Government bonds are not going to be as strong as they were at one point in 2023. So that is the premise that we're going on. So let me share with you my 10 top dividend stocks to buy for 2024.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so I'm going to do this in two batches of 5, starting with Visa as one of my favorite dividend stocks to buy. In fact, one of my favorite stocks to buy. It's the most profitable company that I know of, generating an operating profit margin over 60%, and it's selling at a cheap valuation. I know you're looking at this dividend yield of 0.72% and saying, well, that's not very attractive. But I want to caution passive income investors on this strategy. When you're looking to build passive income, now I know some of you may not have the luxury of time, but when you're looking to build passive income, it's always easiest to start from far away. So let's say if you're 30 years old, start to generate your passive income plans for when you're 75 years old, and then work your way backward. Start with 75 years old, then build your passive income for when you're 70 years old, when you're 65, when you're 60, 55, 50, and work your way backwards. It's easier to do it that way than trying to generate meaningful passive income next year, right? Trying to build that up so quickly will cost a lot of upfront investment. Whereas if you start early, you can get in with stocks like Visa that right now have a dividend yield of 0.72%. But if they continue to perform like they have been, I wouldn't be surprised if this dividend yield doubles or triples in the next decade, right? So you start now and find companies that generate strong profitability, strong cash flow, that don't need to reinvest all that capital into the business, that they can use that money to increase their dividend over time. That's what I've brought you in this video here. Stocks that can do that over time. Maybe they don't have the best dividend yield now, but over the next 5, 10, 15 years, they can grow that dividend meaningfully. And that's Visa to the T. The next one is Altria Group, which does have a very nice dividend yield, 9.55%. It's the best one I'm going to have in this video. Altria Group is also selling at a cheap valuation, a forward PE of less than 10. And Altria Group has done an excellent job increasing profitability in the business, even though it's in the tobacco industry, which is decreasing. The cigarette consumption is decreasing worldwide. The company has still found a way to increase profitability over the last several years, so it's getting better at what it does. Nike is the next one I'm going to suggest, a dividend yield of 1.3%. But this is another one that I wouldn't be surprised if over the next 5, 10, 15 years, it doesn't double or triple the dividend per share in that time. One of the strongest brands in the world. Its strategy of going direct to consumer over the last few years has incrementally increased its profitability, and that's going to generate a little bit more in cash flow that the company can then use to pay shareholders a dividend. Starbucks is the next one, offering a dividend yield of 2.27%. Even though you might feel like there's a Starbucks in every corner, Starbucks is nowhere near the end of its growth. It said it's going to grow locations significantly over the next several years. Of course, international will be the primary focus of its growth. Still, it's got several more years of growth ahead, and that could lead to increasing profit, which will support a growing dividend over the next 5, 10, 15, 20. I don't see Starbucks going anywhere for the next 30 years. Maybe if there's competition that can strike down Starbucks, I don't know. It's gotten so good. It's taken such a strong market share in the over $400 billion coffee market that I think it's here to stay. Next, eBay, which offers a dividend yield of 2.3%. eBay only recently started paying a dividend in 2019. eBay is a quintessential asset-light business model. eBay is just a platform. It just brings together buyers and sellers, and it takes a fee for every transaction on the website. It doesn't do shipping and handling. It doesn't own any inventory, doesn't do any of that. So imagine all of that cash flow that's coming in. eBay doesn't need to put it back into the business. eBay can use that cash flow to pay dividends, right? And so I wouldn't be surprised if eBay doesn't increase its dividend meaningfully over the next 5, 10, 15 years as well, so long as it can sustain the business. Now, eBay's not a growth business, right? It's a low single digit grower. So long as it can maintain that low single digit growth and doesn't lose meaningful market share to Amazon and others, then I think eBay's business model, the asset light nature of the business model, could be very lucrative for passive income investors over the next 5 to 10 years. All right, my next batch of dividend stocks to buy for 2024 starts with Target. Target offers investors a dividend yield of 3.06% with nearly 2,000 locations in the US. Target's investments in its stores over the last several years are proving to be very lucrative. Management did an excellent job in what was in the early 2010s. It was seeming like, oh, Target's at such a disadvantage because it has 2,000 brick and mortar locations where people don't even want to go to anymore. It's all about online shopping. Target is in the dust now. Amazon has taken over. Around 2018, Target turned things around with its investments in the stores that made it attractive. People started going back to Target locations. And then during the pandemic, it made a huge leap forward with its same-day services. People have found this incredibly popular, where you could buy online and pick up in a Target parking lot. Now you can get your order fulfilled in less than a couple of hours. That's an advantage against Amazon. As fast as Amazon is getting, can't be as fast as Target, using its locations, over 2,000 locations, to fulfill online orders. And guess what? It's cheaper to do that too for Target. If it doesn't have to ship it to your home and you're coming to Target to pick it up, that's a much more profitable transaction. I think that strategy is going to pay off for Target and for dividend stock investors buying Target today. Coca-Cola offers investors a dividend yield of 3.13%. Coca-Cola is benefiting from consumers unleashing pent-up demand to get out of the house. Coca-Cola's market share away from home is stronger than at-home consumption. When you go away from home, when you go to a restaurant, a theme park, a movie theater, it's more likely that you will consume a Coca-Cola than another brand. And it's benefiting from that trend. I suspect it'll continue to do that in 2024 and 2025. Home Depot also offering investors a dividend yield of 2.4%. Home Depot management says people spend more money at Home Depot when they feel like they're making an investment in their home versus when they feel like their home is an expense. And people feel more like it's an investment when their home price is increasing. Well, where have home prices gone in the last 3 or 4 years? Straight up to the moon. And so Home Depot's prospects over the next several years look strong because home values are extremely elevated. The next one, the Walt Disney Company, only recently restarting its dividend, offering investors a dividend yield of 0.33%. The House of Mouse is recovering from the devastations during the pandemic. The good news is that its theme parks, its hotels, resorts, cruise ships are a lucrative cash flow generating machine that can support a growing dividend over the next decade or two or more. And finally, Caterpillar is the last one I'll recommend here with a dividend yield of 1.68%. Governments worldwide have enacted fiscal stimulus that include construction spending, and Caterpillar is benefiting from that trend with booming revenue and profitability. And Caterpillar selling at an attractive valuation as well. The stock is not expensive. So there you have it, my top 10 dividend stocks for passive income investors to buy in 2024. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.